In finance, systemic risk is the risk of collapse of an entire financial system or entire market, as opposed to risk associated with any one individual entity, group or component of a system, that can be contained therein without harming the entire system. It can be defined as financial system instability, potentially catastrophic, caused or exacerbated by idiosyncratic events or conditions in financial intermediaries. It refers to the risks imposed by interlinkages and interdependencies in a system or market, where the failure of a single entity or cluster of entities can cause a cascading failure, which could potentially bankrupt or bring down the entire system or market. It is also sometimes erroneously referred to as systematic risk. Explanation: systemic risk has been associated with a bank run which has a cascading effect on other banks which are owed money by the first bank in trouble, causing a cascading failure. As depositors sense the ripple effects of default, and liquidity concerns cascade through money markets, a panic can spread through a market, with a sudden flight to quality, creating many sellers but few buyers for illiquid assets. These interlinkages and the potential clustering of bank runs are the issues which policymakers consider when addressing the issue of protecting a system against systemic risk. Governments and market monitoring institutions and central banks often try to put policies and rules in place with the justification of safeguarding the interests of the market as a whole, claiming that the trading participants in financial markets are entangled in a web of dependencies arising from their interlinkage. In simple English, this means that some companies are viewed as too big and too interconnected to fail. Policymakers frequently claim that they are concerned about protecting the resiliency of the system, rather than any one individual in that system. Systemic risk should not be confused with market or price risk, as the latter is specific to the item being bought or sold and the effects of market risk are isolated to the entities dealing in that specific item. This kind of risk can be mitigated by hedging an investment by entering into a mirror trade. Insurance is often easy to obtain against systemic risks because a party issuing that insurance can pocket the premiums, issue dividends to shareholders, enter insolvency proceedings if a catastrophic event ever takes place, and hide behind limited liability. Such insurance, however, is not effective for the insured entity. One argument that was used by financial institutions to obtain special advantages in bankruptcy for derivative contracts was a claim that the market is both critical and fragile. Systemic risk can also be defined as the likelihood and degree of negative consequences to the larger body. With respect to federal financial regulation, the systemic risk of a financial institution is the likelihood and the degree that the institution's activities will negatively affect the larger economy such that unusual and extreme federal intervention would be required to ameliorate the effects. A general definition of systemic risk which is not limited by its mathematical approaches, model assumptions or focus on one institution, and which is also the first operationalizable definition of systemic risk encompassing the systemic character of financial, political, environmental, and many other risks is available since 2010. Measurement of systemic risk. Tbtf, TICTF. According to the Property Casualty Insurers Association of America, there are two key assessments for measuring systemic risk: the too big to fail and the too interconnected to fail tests. First, the Tbtf test is the traditional analysis for assessing the risk of required government intervention. Tbtf can be measured in terms of an institution's size relative to the national and international marketplace, market share concentration, and competitive barriers to entry, or how easily a product can be substituted. Second, the TICTF test is a measure of the likelihood and amount of medium-term net negative impact to the larger economy of an institution's failure to be able to conduct its ongoing business. The impact is measured beyond the institution's products and activities to include the economic multiplier of all other commercial activities. dependent specifically on that institution. The impact is also dependent on how correlated an institution's business is with other systemic risks. Too big to fail. The traditional analysis for assessing the risk of required government intervention is the too big to fail test. Tbtf can be measured in terms of an institution's size relative to the national and international marketplace, market share concentration, and competitive barriers to entry, or how easily a product can be substituted. While there are large companies in most financial marketplace segments, the national insurance marketplace is spread among thousands of companies, and the barriers to entry in a business where capital is the primary input are relatively minor. The policies of one homeowner's insurer can be relatively easily substituted for another or picked up by a state residual market provider, with limits on the underwriting fluidity primarily stemming from state-by-state regulatory impediments, such as limits on pricing and capital mobility. During the recent financial crisis, the collapse of the American International Group posed a significant systemic risk to the financial system. There are arguably either no or extremely few insurers that are Tbtf in the U.S. marketplace. Too interconnected to fail. A more useful systemic risk measure than a traditional Tbtf test is of too interconnected to fail assessment. An intuitive TICTF analysis has been at the heart of most recent federal financial emergency relief decisions. TICTF is a measure of the likelihood and amount of medium-term net negative impact to the larger economy of an institution's failure to be able to conduct its ongoing business. The impact is measured not just on the institution's products and activities, but also the economic multiplier of all other commercial activities dependent specifically on that institution. It is also dependent on how correlated an institution's business is with other systemic risk. SRISK. A financial institution represents a systemic risk if it becomes undercapitalized when the financial system as a whole is undercapitalized. In a single risk factor model, Brownlees and Engel build a systemic risk measure named SRISK. SRISK can be interpreted as the amount of capital that needs to be injected into a financial firm as to restore a certain form of minimal capital requirement. SRISK has several nice properties. SRISK is expressed in monetary terms and is, therefore, easy to interpret. SRISK can be easily aggregated across firms to provide industry and even country-specific aggregates. Last, the computation of SRISK involves variables which may be viewed on their own as risk measures, namely the size of the financial firm, the leverage, and a measure of how the return of the firm evolves with the market. Because these three dimensions matter simultaneously in the SRISK measure, one may expect to obtain a more balanced indicator than if one had used either one of the three risk variables individually. Whereas the initial Brownlees and Engel model is tailored to the U.S. market, the extension by Engel, John Doe, and Rockinger allows for various factors, time-varying parameters, and is therefore more adapted to the European market. One factor captures worldwide variations of financial markets, another one the variations of European markets. Then this extension allows for a country-specific factor. By taking into account different factors, one captures the notion that shocks to the US or Asian markets may affect Europe, but also that bad news within Europe matters for Europe. Also, there may be country-specific news that do not affect Europe nor the USA but matter for a given country. Empirically, the last factor is found to be less relevant than the worldwide or European factor. Since risk is measured in terms of currency, the industry aggregates may also be related to gross domestic product. As such, one obtains a measure of domestic systemically important banks. The SRISK systemic risk indicator is computed automatically on a weekly basis and made available to the community. For the US model, risk and other statistics may be found under the Volatility Lab of NYU Stern School website, and for the European model under the Center of Risk Management website of HEC Lausanne. Valuation of assets and derivatives under systemic risk. Inadequacy of classic valuation models. One problem when it comes to the valuation of derivatives, debt, or equity under systemic risk is that financial interconnectedness has to be modeled. One particular problem is posed by closed valuations chains, as exemplified here for four firms A, B, C, and D. B might hold shares of A, C holds some debt of B, D owns a derivative issued by C, and A owns some debt of D. For instance, the share price of A could influence all other asset values, including itself. The Merton model situations is the one explained earlier, which are present in mature financial markets, cannot be modeled within the single-firm Merton model, but also not by its straightforward extensions to multiple firms with potentially correlated assets. To demonstrate this, consider two financial firms with limited liability, which both own system exogenous assets of a value at a maturity, and which both owe a single amount of zero coupon debt, due at time. System exogenous here refers to the assumption that the business asset is not influenced by the firms in the considered financial system. In the classic single-firm Merton model, it now holds at maturity for the equity and for the recovery value of the debt. That an equity and debt recovery value, and, are thus uniquely and immediately determined by the value of the exogenous business assets. Assuming that the are, for instance, defined by a Black-Scholes dynamic, risk-neutral no arbitrage pricing of debt and equity is straightforward, non-trivial asset value equations. Consider now again two such firms, but assume that Firm 1 owns 5% of Firm 2's equity and 20% of its debt. Similarly, assume that Firm 2 owns 3% of Firm 1's equity and 10% of its debt. The equilibrium price equations, or liquidation value equations, at maturity are now given by this example demonstrates that systemic risk in the form of financial interconnectedness can already lead to a non-trivial, non-linear equation system for the asset values if only two firms are involved. Over- and underestimation of default probabilities. It is known that modeling credit risk while ignoring cross-holdings of debt or equity can lead to an under, but also an overestimation of default probabilities. The need for proper structural models of financial interconnectedness in quantitative risk management, be it in research or practice, is therefore obvious. Structural models under financial interconnectedness. The first authors to consider structural models for financial systems where each firm could own debt of any other firm were Eisenberg and No in 2001. In their model, no equity could be cross-owned, and debt had to be of one seniority level only. In 2002, Suzuki published a model in which equity could be cross-owned as well. His model was developed independently of Eisenberg and Noe's. Elsinger's publication of 2009 was the first in which debt could be of different seniorities, hence allowing to model, for instance, senior and junior debt, while correctly accounting for the order of priority. His model allowed equity cross-ownership, too. With Fisher, the first model which also allowed derivatives was introduced. The fact that Elsinger was unaware of Suzuki's publications, Fisher was unaware of Elsinger's, and the fact that other authors rediscovered parts of Suzuki's and Elsinger's results shows that the research in this field is still somewhat unconsolidated. Risk-neutral valuation. Price indeterminacy in open problems. Generally speaking, risk-neutral pricing in structural models of financial interconnectedness requires unique equilibrium prices at maturity independent of the exogenous asset price vector, which can be random. While financially interconnected systems with debt and equity cross-ownership without derivatives are fairly well understood in the sense that relatively weak conditions on the ownership structures in the form of ownership matrices are required to warrant uniquely determined price equilibria. The Fisher model needs very strong conditions on derivatives, which are defined in dependence on any other liability of the considered financial system, to be able to guarantee uniquely determined prices of all system endogenous liabilities. Furthermore, it is known that there exist examples with no solutions at all, finitely many solutions, and infinitely many solutions. At present, it is unclear how weak conditions on derivatives can be chosen to still be able to apply risk-neutral pricing in financial networks with systemic risk. It is noteworthy that the price indeterminacy that evolves from multiple price equilibria is fundamentally different from price indeterminacy that stems from market incompleteness. Factors that are found to support systemic risks are economic implications of models are not well understood. Though each individual model may be made accurate, the fact that all models across the board use the same theoretical basis, and the relationship between financial markets and the economy is not known, led to aggravation of systemic risks. Liquidity risks are not accounted for in pricing models used in trading on the financial markets. Since all models are not geared towards this scenario, all participants in an illiquid market using such models will face systemic risks. Diversification. Risks can be reduced in four main ways: avoidance, diversification, hedging and insurance by transferring risk. Systematic risk, also called market risk or undiversifiable risk, is a risk of security that cannot be reduced through diversification. Participants in the market, like hedge funds, can be the source of an increase in systemic risk, and transfer of risk to them may, paradoxically, increase the exposure to systemic risk. Until recently, many theoretical models of finance pointed towards the stabilizing effects of diversified financial system. Nevertheless, some recent work has started to challenge this view, investigating conditions under which diversification may have ambiguous effects on systemic risk. Within a certain range, financial interconnections serve as shock absorber, but beyond the tipping point, interconnections might serve as shock amplifier. Regulation. One of the main reasons for regulation in the marketplace is to reduce systemic risk. However, regulation and arbitrage, the transfer of commerce from a regulated sector to a less regulated or unregulated sector, brings markets a full circle and restores systemic risk. For example, the banking sector was brought under regulations in order to reduce systemic risks. Since the banks themselves could not give credit where the risks were high, it was primarily the insurance sector which took over such deals. Thus, the systemic risk migrated from one sector to another, and proves that regulation of only one industry cannot be the sole protection against systemic risks. Project risks. In the fields of project management and cost engineering, systemic risks include those risks that are not unique to a particular project and are not readily manageable by a project team at a given point in time. These risks may be driven by the nature of a company's project system, capabilities, or culture. They may also be driven by the level of technology in a project or the complexity of a project's scope or execution strategy.